Good evening. It is time for today's Tax Talk. I'm your host. I'm attorney Stephen Leahy. It is Crypto Tuesday, November 29th, the year of our Lord 2022. And, as you know, this is today's Tax Talk, and we talk about taxes. And today's Crypto Tuesday, so we're going to talk about taxes and Crypto Tuesday. And crypto, that's what we're going to do today. Won't you join us? Today's Tax Talk. So, the IRS has a criminal investigation unit called, and part of the $80 billion in this, the Inflation Reduction Act, part of that $80 billion, most of that $80 billion is being used for collections. And part of the collections is criminal investigations. And so I've been warning people that this is, they're going after this tax gap. One of the things I think is going to happen is they're going to start bringing a lot more criminal cases, at least criminal investigations against citizens, against business owners and such, and because they've been already accusing them of crimes. They're being criminals. They're cheaters. They're liars. They're tax fraud. Even though I don't think that's what goes on a lot. Yes, some people owe the IRS money, but not because they're trying to steal from the IRS. Sometimes it goes a lot. It's a lot more complicated than that. It's easy to call them criminals, but they're not criminals. But yet now I believe that's what's going to happen. But anyway, there's a good story today. But before we start before we talk about that story, we'll begin where we always begin on Crypto Tuesday, and that is on our favorite site, coinflip.tech, and look at the markets. We always look at the markets. Again, looks like a little bit different between Ethereum and Bitcoin, but pretty much the same. It's up almost 4%. Bitcoin up almost 4% today, and Ethereum up 9%. So, but pretty straightforward, big tick up in the late in the day. So here's the last week for Bitcoin. Did take a dive, I think, when the new bankruptcy came out for that. There's still a lot of angst and anxiety about these accounts, the brokerage accounts, and FTX and the new bankruptcies that are the new bankruptcy that filed, and some that are on the horizon, and so people are concerned about it. But it still is trading in a small band. It's not nearly as volatile as it once was. This is the story. The IRS is coming. The IRS is coming for crypto, and it's true. We all know that, though, because they've been talking about it. The IRS has been talking about it for a long time. But now this story is about crypto and criminal investigation unit. Crypto cases will top the agency criminal investigation to-do list in 2023. The Internal Revenue Service's criminal investigation function is charged with investigating allegations of criminal tax fraud and assisting the Department of Justice with the prosecution of cases. The Inflation Reduction Act is breathing new life into the IRS enforcement action, including CI. Next year, the agency intends to hire an additional 360 special agents. I think that's like almost a 15% increase, who will investigate alleged tax, and that's just next year, right? That $80 billion is over the next 10 years. Who will investigate alleged tax and financial crimes, along with another 150 professional support staff. These include technology experts trained to unravel complicated digital transactions. They will push CI's workforce to 2,427 special agents and 1,088 special support staff, the highest it's been since 2010. The complicated digital transactions awaiting scrutiny are cryptocurrency transactions, according to CI's 2022 annual report. We reviewed that annual report here on today's tax talk. Digital assets pose a significant risk of facilitating money laundering, cybercrime and ransomware, narcotics and human trafficking, terrorism and proliferation financing. Digital assets may also be used as a mechanism to circumvent U.S. tax law and financial sanctions. Isn't that the same with dollars? All of those things that they're saying is crypto. Aren't U.S. dollars used for that also? All of that? Just an observation. This is why CI is currently teeing up hundreds of crypto cases for investigation and potential prosecution. Such cases will be a priority throughout 2023. In fact, because of the rise in crypto cases overall, in 2021, the IRS created the Office of Cyber and Forensic Services under the umbrella of CI. That office unifies the agency's digital assets investigation, cybercrime investigations, digital forensics, and physical forensic support teams all in one place. A key priority, according to the annual report, is to investigate the illicit uses of digital assets and how they can be used to exploit the U.S. tax and financial system. The Internal Revenue Code does not address the tax consequences for cryptocurrency in particular. A few years after its emergence on the scene in 2009 as a financial asset, IRS Notice 2014-21 deemed virtual currency, Bitcoin in particular, as property, to be treated no differently than a share of stock or an automobile. The IRS refers to virtual currency as convertible currency in that it has a value measured in real currency, or it acts as a substitute for real currency. Any one of the hundreds and growing of today's digital currencies meets this broad definition. Tax problems with cryptocurrency arise as a result of two issues: the failure to report the gains on trading crypto assets and the failure to report income paid in the form of crypto assets. Let me address them in turn. Reporting crypto gains. When Bitcoin showed up on the market in 2009, it was essentially worthless. By the end of 2009, it had some value, only because of a very limited trading. However, by November 2021, at its peak, one Bitcoin was worth nearly $69,000. As of this writing, it is trading for about $16,440. Much trading was done by investors throughout this wild ride. Those who bought low and sold high, the key to making money, I'm told, realized the gain on their trades. The gain is taxable as income. For example, suppose you purchased crypto at $5 per coin and sold it at $15. You realized a gain of $10 per coin. This gain is subject to capital gains tax. The rate of tax depends on the number of factors, most notably the period of time for which you held the asset. The problem is that people often do not understand that gains realized from trading crypto must be reported and paid tax, and tax paid. But as I point out above, as early as 2014, the IRS classified virtual currency as an asset to be treated for tax purposes just like any other asset. The other element of the trading problem shows itself when there is a mere portfolio transactions. Suppose you have a portfolio of 50 Bitcoin worth $1,000 each. Your basis cost price in each Bitcoin is $100 each. You trade all your Bitcoin for some other digital currency without taking any cash from the portfolio. The typical taxpayer would probably believe there are no tax consequences for this trade because he took no cash. He would be wrong. The swap of the Bitcoin is treated as a sale. The fact that you acquire another digital currency without taking cash in the process does not change the fact that you, in fact, sold Bitcoin. It's no different from selling 100 shares of IBM stock and using all the proceeds to purchase 3M stock. You are taxed on the profit of the IBM stock, measured as the difference between the purchase and the sales price. Payments in crypto. Now let's address what happens when you take crypto as payment for goods or services rendered. Suppose you're in a business as an attorney. Well, I can imagine that. Your retainer fee is $5,000. A client pays you with 5 crypto coins worth $1,000 each. The fair market value of the coins as of the date that they are paid to you is $5,000. That amount must be reported by you as income in the year received. Now, you may counter by saying that since you didn't sell the coins, there's no profit. Not true. Your profit is measured by the fair market value of the coins as of the date you took them as payment. At this point, your basis, the purchase price, in the coin is equal to the fair market value of the date of receipt. In this case, $1,000 per coin. Suppose you sell the coins later for $1,500. At that point, you have a profit, a capital gain of $500 per coin, which you also must be reported on your tax return in the year of the sale. On the other hand, if you sell for $800 per coin, you have a loss of $200 per coin, which may be claimed as a capital loss, subject to certain limitations, in the year of the sale. Too many people believe that the IRS has no way to track digital currency, and therefore, if one fails to report trades, nobody will be wiser. This is a serious mistake. The IRS has made great strides in tracking digital currency. The best proof of this is the case of Liechtenstein and his wife, Heather Morgan of New York. The pair were arrested in Manhattan in February 2022 and charged with conspiracy to launder $4.5 billion in Bitcoin that they allegedly stole by hacking a virtual currency exchange in 2016. The IRS's CI was instrumental in breaking the case. CI traced this crypto using the Bitcoin blockchain to various destinations, including accounts on the dark web, 7 interconnected accounts at various virtual currency exchanges, various unhosted Bitcoin wallets, accounts owned by Liechtenstein at 6 virtual currency exchanges, and an unhosted Bitcoin wallet containing most of the stolen crypto. CI assessed the wallet by encrypting a file saved in Liechtenstein's cloud account, which it obtained via a search warrant. The cloud account contained at least 2,000 virtual currency addresses, along with corresponding private keys. Special agents then recovered more than 94,000 Bitcoin, valued at $3.6 billion at the time of the seizure. For all the bungling of the IRS sometimes displays, the agency's special agents are not among the bunglers. No, they're totally different. They are highly trained professionals who are singularly focused and know exactly what they are doing. If you have crypto profits, do not make the mistake of believing that the IRS cannot or will not find them. The agency is making these cases a priority in 2023. If you are unaware or unsure of the tax consequences of your crypto trades, do not go alone. Get counsel. Proceeding otherwise is simply not worth the risk. For that matter, none of the above should be treated as tax advice. If you have questions in this area, please get in touch with your tax advisor. Okay, so I thought that was an interesting story, not because they advise you to get counsel. But first off, there's this underlying theme that that people who are trading or are in business are thieves and they're looking to steal from the IRS. And I just think that that's false. Are there people who will not report things? Yes. Yes, there are. But most people report most or all of what they get. It's just a fact. Most people are honest people. They're not thieves and liars, even to the IRS, even if they think the IRS, the tax system is unfair. And I think it is unfair in many instances. But even though people think it's unfair, I don't believe there's a lot of people out there trying to steal from the IRS. Now, having said that, does that mean that all of these people understand how to account and tax, how crypto's taxed? Well, no, they don't understand it. Most people don't understand any of the tax code. So if they don't report it because they don't know, that's not criminal. I just didn't know. But once you know and then you do it, that's a different matter. Okay, so anyway, that's kind of where I come. I have a couple of minutes. I'm going to read this story because this is important also, because this shows you how far along the IRS will go, what they will do to get the information that they're after. Okay, since at least 2016, the IRS has been ferreting out taxpayers who fail to report their taxable gains from cryptocurrency transactions by using John Doe summonses to crypto exchanges and dealers. See, a John Doe summons means they don't know who it is. So they just name John Doe, and then they go to the broker or the banks, and they look at all of their accounts and then compare it to what's been reported. A John Doe summons enables the IRS to obtain information such as a list of unrelated customers from a business or service provider that is not itself a target of the investigation. John Doe summons are often used when the IRS has a reasonable basis to believe that targeted customers failed to comply with one or more provision of the tax law, but the IRS cannot determine the taxpayer's identity. Thus, a John Doe summons serves as an information gathering tool for the IRS. In August, the IRS issued a John Doe summons seeking customer information from Sofox, a cryptocurrency prime dealer and trading platform with more than 175,000 registered users. The summons explicitly stated that SFOX itself was not alleged of any wrongdoing. The IRS also sought to issue a related John Doe summons to a banking institution that had partnered with SFOX to offer SFOX's users access to cash deposit bank accounts at the bank and thereby facilitate the crypto trading activity of such SFOX customers. On September 21st, the U.S. District Court of the District of New York approved this John Doe summons to M.Y. Safa Bank. Interestingly, by issuing these summons to both the crypto dealers and banks involved in the targeted customers' crypto, the IRS has effectively increased the investigatory power of a single summons, standing alone, and likely gained a more comprehensive understanding of any identified taxpayer's crypto activity. It is unclear if such concurrent summons will now become a norm for the IRS whenever a bank has a close relationship with a particular crypto exchanges and dealers. At least one taxpayer is challenging the validity of using John Doe summons for crypto. The IRS's use of John Doe summons in these concurrent situations may also be subject to future challenge. We did a story on the show about these. I tried to look it up, but I couldn't find it before we went on. But about the IRS or the Department of Justice getting these John Doe summons to go after bank deposits boxes in a safety deposit box, I should say, and because they weren't in a bank, it was a deposit box company, and they went in and confiscated all of the property in all of those boxes. There was no need to prove that there was any wrongdoing. They just went in and confiscated it all. Interesting, isn't it? In 2020, this person who was identified to the IRS in response to a John Doe summons served on the cryptocurrency exchange platform Coinbase, challenged the validity of the Coinbase summons by failing to satisfy the statutory issuance requirements and on the grounds that it violated his Fourth and Fifth Amendment rights. Without addressing the merits, the IRS moved to dismiss the case as prohibited by the Anti-Injunction Act, which bars suits whose purpose is restraining the collection or assessment of a tax. The district court agreed. However, the First Circuit Court of Appeals recently reversed that ruling and allowed the case to continue to determination on the merits. The First Circuit narrowly read the AIA to only prohibit actions directly involving collection or assessment. Since a John Doe summons only implicates the IRS's information gathering efforts, the court found that such summonses fall outside the reach of the AIA. While the taxpayer's constitutional procedural claims in this case may not ultimately succeed, the taxpayer has at least won his right into claims adjudicated on the merits. And if the defendant does ultimately succeed, the implications for the IRS's use of the John Doe summons could be wide-ranging. That case indicates that, at least as a preliminary matter, future challenges to the validity of the John Doe summons issued concurrently to crypto dealers and partnering banking institutions may be adjudicated, and the taxpayers as well as the crypto industry may have another opportunity to challenge the John Doe summons. Okay, so interesting cases. I'm just trying to point out to you that crypto is the target. But crypto is not the target. Taxpayers with crypto are the target, and they're going to use the Criminal Investigation Unit to find them. And again, first off, I always say, most people are honest, and if you're honest, you have nothing to hide. I don't like the fact that they could go in without a warrant, these John Doe warrants, and collect everybody. As I mentioned, that case where they went in and confiscated everything in every safe deposit box without knowing that there was any crimes involved. They suspected some might be criminal, but they didn't know which one and who. And so it really put I think it was a violation. But that's my opinion. The courts don't always agree with me, unfortunately. That's why we argue them in court. So anyway, thanks so much for joining us. I appreciate you taking the time to these are interesting cases, and I always find it, I like to share them with you. So remember to like and share our content. We need to get it out, and we need your help to do it. Remember, if you have IRS problems, if you want to fight the IRS because you owe them money and or you have unfiled tax returns and you don't know what to do, first thing you should do, get a copy of my book, Deal with Your IRS Problem Today. Go to freeirsbook.com, freeirsbook.com. That's freeirsbook.com. Get your free copy of Deal with Your IRS Problem Today. I will pay for the printing. I will ask you to pay for the shipping and handling. That's a small shipping and handling fee. And there's lots of bonuses involved. You'll see that at freeirs.com, book.com, freeirsbook.com. I have a list of bonuses there if you are so inclined to get a copy of the book. So thanks so much for joining us. I appreciate you taking the time. And we'll see you right back here tomorrow. God bless. Thanks again.